Hi, good day, good evening, wherever you are. Welcome to our global series, a trader's education plan from beginner to professional. Today, it's the 7th of November 2018. This is Berlin office from Admiral Markets. Jens Schwanowski speaking. I will give you the introduction. Before then, Markus Gabel will start as the main presenter today. Let's start like every day with our risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk, which is not suitable for all investors due to their complex nature. If you are a starter, please start with a demo account and make yourself familiar with long trading, short trading, leverage trading, and your personal risk management. If you'd like to read the full risk disclaimer, just visit one of our regional web pages, for example, admiralmarkets.com, and you will find the long version also there. If you are in the European Union, you can also get some information about the different options and offer for retail clients and professional clients. As you maybe know, it's a topic of the year. The margin requirements and leverage is quite different. Since August 2018, a picture shows more than 1,000 words. Two prominent examples, DAX 30, also Euro dollar. Retail client and professional client margin requirements could be quite different. If you're a professional trader, you can read about the criteria and apply for the professional client status if you met them. Retail clients still have a big benefit. They get an unlimited protection against negative balances via the regulation. Professional clients don't get it via regulation, but some brokers and of course also Admiral Markets will have another protection for you. We call it negative balance protection policy up to 50,000 British pounds, what is around about 70,000 euro. Also, the professional clients will be protected. All details, how to apply for it and more via that link, it is displayed at admiralmarkets.com. And doesn't matter if you retail client or professional client, anybody gets the same spreads, DAX 30, Euro dollar. Two examples, typical spread of just 0.8 points or pips during main trading hours without additional commission. Also here, check it out on the regional web pages like, for example, admiralmarkets.com. And if you'd like to read more about what we are doing globally, yes, we are a global broker. We are doing activities in Chile, but also in Australia, and of course in the European Union. If you'd like to find out more, just visit our webpage and you'll find a webpage which describes all our global offers. Now, enough from my side. Now it's time for Markus. Good morning, good day, Markus, or good evening, wherever you are. This is our global webinar. What's your presentation? Usually I say, what's your view to the market today? But today it's not the main focus to the markets. So let's speak about the educational part. Now it's your part.
Thanks, Jens, and a great evening, and thank you for your introduction this evening. Yes, this is a global webinar, and this is our education webinar. And a warm welcome from my side to everybody, wherever you are. Yes, Jens is right. We have members here from Croatia, from USA, from Bulgaria. I'm very happy that you'll be a part of that. And Jens, thanks for the great introduction. Yes, we don't want to talk about the market today. This is the education series. And as you know, we talk about markets and instruments. This is the main topic. Last week, we talked about the first instruments, about CFDs and shares. And today, it's a little bit really interesting because today is our special topic, the Forex market, which we trade every day and every week. And you know, tomorrow at 11, we have the next webinar. We have a look at the market, which trades we made, and we can make in the next hours. But today, I want to tell you, and I want to tell you a little bit about the background of the Forex market. Maybe it's not necessary to make trades every day, but it's good to know, as we say, to know how the Forex market were developed and how we can trade the Forex market. And I have my own notes here, so mostly I look at the left side because there's my notes, and so maybe you can take a little bit paper and your pen, and you can make your own notes, because maybe it's an interesting topic. If you have some questions, let me know. I can see it in the chat box. Forex market, every day. We trade every day in currency, in Forex market. Every day we make trades in euro, in US dollar, in Swiss franc, in Canadian dollar, whatever we do. every day, the Forex market has a huge amount of 5 billions. So not it's called $1 trillion, but it's in German we say $1 billion. $5 billion every week were traded in the Forex market. But how was the development of the Forex market? Where was the origin of the Forex market? And about that background, I want to tell you a little bit. It was the year 1871, a long, long time ago. In the year 1871, the gold standard was the origin, you can see it here, was the origin and were created in Mark. In German we say Mark, and the called gold standard. So it was a general currency at Germany in that time, and it was 1 mark was 100 penny, or in German Pfennige. So, and all the other currencies at that time in the year 1871, we had there in this time is euro, but at that time there were different countries. We had Groschen, Heller, Kreuzer, Schillinge, Thaler, Gulden, Dukaten, everything in every German kingdoms and free towns. Every town has its own currency at that time. And in the year 1871 was the rule, or the Reichsmünzgesetz. It was called like that. It was the origin of the mark and the gold standard. 1 mark was based on gold, in gold currency, and the people at that time made sure that only so many mark you can have, how you can buy in gold as well. That's really important. So that at that time it was not possible that there was more mark in the surrounding as you can have in gold. So that was really I said a really good balance at that time, better than today, for example. In the year 1880, there were additionally printing bank notes, and you can exchange, you can change it in gold, in gold coins, yes, in gold coins. And but the central banks have to make sure that they have in their stocks the same on gold as there were coins and banknotes outside the people can have or can use to pay something what they want to buy. This system of money was able and valid until the year 1914. Maybe you know what was happened in 1914, the First World War. And at that time, 1 gold coin has a value of 4.25 D-Mark, or mark at that time. So 1 gold coin has a value of, or had a value of 1.25 mark. But this gold, so it was a really fixed currency ratio, and that was a good time. So everybody knew what it means if you have 1 mark and you have a gold coin. It was really easy at that time. But this gold standard wasn't valid for everlasting. That's was not possible. The central banks has the task, the gold reserves they had in the stocks to hold in the surrounding of the country, to be able every time to pay in gold or in mark or in banknotes. So it was a really balance between the coins or the gold and notes, between gold and notes and coins. That was a really valid and well-working balance at that time. But this gold standard was able between every country at that time in the year 1940. So the gold was able to move in a free way between every countries, Germany, France, British, Great Britain, and whatever. In all that countries, gold was able to handle and to move between all that countries in a free way. It was not regulated at that time. So, but it was the base of a fixed exchange system between all the amount of money in the special countries. Sorry, sometimes I have to translate something, but my notes are everything in Germany. So the origin of that first gold standard was the same at the Bank of England in the year 1845 with the Bank Charter Act, the same at the gold standard, and silver as well. The end of that gold standard was in the year 1940. Why? The cost to financial, the First World War exploded. It was so expensive to financial this First World War of every country that the gold standard wasn't able to keep strong in that time, because we have yes, the war was extremely expensive at that time, and the inflation of the involved countries was too much, and it wasn't able to keep strong that gold standard in the year 1914 and at the end 1918. So it wasn't able to keep strong this gold standard. In the year 1933 was the end of the gold standard in the USA, because they had the same problem. The inflation was too huge at that time, and they have a great bank crisis. You know, the Black Friday 1929, and that was the end of the gold standard in the year 1933. And all the other countries, it was a normal reaction of all the other countries at that time. First Germany and the other around in the First World War, then USA, then Canada, then Cuba, and all the other Middle American countries avoided to make or finished this gold standard, and cause the possibilities to have a great or a strong economic growth wasn't longer able to keep strong at that time. In the year 1944, they created the called Bretton Woods character, or the Bretton Woods contract. So what does it mean? At that time, Mr. Dexter White and Mr. John Maynard Keynes, maybe you heard some of that names, they had two different opinions how the currency market has to work. In the year 1944, at the 1st of July, all countries which have own currencies met in the Mount Washington Hotel in Bretton Woods. That was the country, that was the town, I need the right word. So just a moment, I've put it at my note. Where is it? I can't read my own notes here. So let's see. To build up, yes, to build up the Europe after the Second World War, and they met in Bretton Woods at that time, and to stabilize the different currencies between the different countries in their trading to each other. And the problem, we had two proposals at that time. The first one from Mr. White and one of the Mr. Keynes. Mr. Keynes, they said how the currency market has to work. Finally, they made the decision in Bretton Woods, in the Bretton Woods system, and they decided to make the Mr. White plan. In the core was the US dollar as a fixed currency ratio between all the other currencies. So the core was the dollar, and every other currencies was close to the dollar, and this was the final decision of the Mr. White plan and the conclusion of the Bretton Woods contract in the year 1944, especially in 1945. And it was able and it was valid until the year 1972. I was 2 years old at that time. And with the Bretton Woods system, they hoped the world economy to stabilize, to have a great connection between all the different economics, between all the different countries. That was the functionality of this Bretton Woods contract or system. But the exchange ratio was a fixed ratio of between the different currencies. And that was interesting, the dollar was closed to gold, to 1 ounce of a gold. That was interesting. So they failed in the gold standard, but they made it close, the dollar to the gold. So $1, the 1 gold ounce had a value of $35 at that time in the year 1945. So, and the Federal Reserve said, and has the responsibility to make sure that they can unlimited buy or sell gold. That was the tax of the Federal Reserve at that time. That was the reason why the price of gold was fixed for years and years and years ago. It's not believable. It's unbelievable in our time today, because we are handling gold every day, maybe. And in the year 1944, all members made an agreement to be members of this Bretton Woods system, and they made sure that they avoid to make intervention in this system. It was a great time between 1945 and 1972. But the collapse was programmed ahead. In the year 1973, the Bretton Woods system collapsed completely. Why? They made a great mistake, and that was the big mistake was Mr. Keynes knew at that time, but they decided to Mr. White's plan, the Bretton Woods plan at that time. The great mistake was that they didn't figure out that the world comes closer and closer together. They're working more together. The world trades increase a lot, and more countries and governments wanted to have the dollar. So we have an increasing demand of the dollar from all the countries, because the core of the Bretton Woods was the dollar. Every single currencies was closed and fixed to the dollar. That was the big problem. And in the year 1960, the $35 per ounce of the gold wasn't strong enough. It was not able to hold this standard between the dollar and the value of the ounce from one gold in $35. It was a game. It was a game of supply and demand. It's the same game as today. And they made the mistake that they didn't hold the rules of trading at that time. They made the mistake to figure out that was a game of supply and demand. That was the problem of that Bretton Woods contract. So, what was the beginning of that collapse? The France. It was up to the France at that time. In the year 1966, France wanted to have back all gold, and not in payment, in physical gold. And the USA wasn't able to deliver all that physical gold what France wanted to have. That wasn't able. And Mr. Nixon stopped in the year 1971. I was 1 year old at that time. Stopped this Bretton Woods contract, that the dollar was closed to the gold. That was the called Nixon shock in the year 1971. The completely Bretton Woods system collapsed in the year 1973, because the system of fixed currency or the currency ratio with a volatility of plus and minus 1% was very weak. Why? Because the different economics in the different countries increased in a different way. And ladies and gentlemen, this is the reason why the EU, the European Union, wasn't able or is not able and won't able to be stable in our future. The gold standard failed, the Bretton Woods contracting system failed, and I feared the euro will fail as well. Let's go on. In the year 1900, let's see, in the year 1979, the EWS, it was the former to the European Union today, was developed, and the origin, and we have this between 1972 and 1979. We have this EWS, and so we have the different flexible prices or flexible curses between the US dollar, but with a fixed volatility of 2.25%. This was a fixed volatility. It was valuable at that time, and it was fair valued at that time. And every currency has a volatility between plus minus 2.25 and a volatility in 1993 of 15%, but it was fixed between 2.25 and 50% between 1979 and yes, 1993 to 50%. In the year 1979, the European currency system comes together to fix every currency in all that member countries of the EWS. And now, in my opinion, comes one of the interesting stories ever. Maybe you know the man who broke the Bank of England. I try to tell it to you in an interesting way. What was happened at that time? It was the year 1992. The British pound were handled at that time in a fixed currency price of 2.995 mark, D-Mark, German mark, and a volatility of plus minus 6%. And which means on the upper side it was closed at a 3.12 German mark, and on the lower side at 2.73 German mark. When Great Britain was a member at the EWS in the year 1990, they made sure that they said they were also responsible to hold on that volatility, plus minus maximum 6%. But the British pound was from the beginning, when they were a member at the EWS, was too strong against the German D-Mark. Cause it's like today, it's interesting, it's like today, because the European economy or the German economy was in that year 1992 very, very strong, and so much stronger than the British, the economy of the British environment and of Great Britain. But the Great Britain had the hope that they can a little bit participate at the strong economy of the German economy. That was the idea of Great Britain, and that was the reason why they were a member of the EWS. But the German D-Mark was too strong for the British pound. And then, you know, the East Germany and West Germany comes together, and the inflation in Germany rose up about that event at that time. And that was the beginning of the end of that history, because the Central Bank of Germany must raise up about that higher inflation, the interest rates from, listen, it's interesting, from 6% in the year 1990 to 8.75% in the year 1992. Imagine, today we have an interest rate from 0. At that time, they raised it up from 6 to 8.75. In the year 1992, in September the 15th, the day before the Black Wednesday, the interest rates were decreased a little bit to 8.25, from 8.75 to 8.25. And now the problem was, that every other countries must increase their own interest rates as well. The other way, they were not able to hold the 6% rule. Because the rule was in the EWS only had to have a volatility in the own currency of 6%. And Great Britain said we made the same. We can hold this 6% plus minus on the upper and the lower side of volatility. For Germany, this interest increasing of the interest rates, it was okay because they had a strong economy at that time in the year 1992, but not in the other countries, especially not in Great Britain or in Italy. Maybe you remember that today. I guess it's the same situation. The problem was that the interest rates of Great Britain, the economy makes very weak. That was the problem in Great Britain at that time. A lot of householders were not able to pay that expensive interest rates. They were not able to buy that. That was the first house crisis in that time. So Great Britain made in that time a lot of pressure to the central bank of Germany. They said, I don't care. We are not involved in the politics. We have our own rules, and Germany was very strong at that time. And they said, doesn't matter, make your own stuff. You came into the EWS and you made, Great Britain I mean, you made sure to hold a 6% of volatility in that time. But this high value of the British pound leads that a lot of speculators said the British pound is too expensive. And I guess you know the man who broke the Bank of England. His name was George Soros. Mr. Soros and a lot of other speculators built up huge short positions at the British pound. Alone Mr. George Soros borrowed billions of British pound at the British banks and bought in return German mark and France and the French franc. With his own investment fund, he was involved with $1 billion against the British pound, because he knew that the British pound was too high valued in that time, and he knew they cannot hold the lower price or the lower border of this 6% of volatility, which called 2.73 German mark. In the morning of September in the year 1992, of the September the 16th, in that morning, the British pound reached the lower border of the 6% volatility, exactly 2.73 German mark. The Bank of England tried with some interventions to push up or to hold this line, this border of 2.73 to the British, from British pound to the German mark. But it doesn't work. And then they made a decision what in our time would be not possible. They increased the interest rates in Great Britain at one day from 10 to 12%. They increased the interest rates from 10 to 12% on one day, and a few hours later, a second interest rate from 12 to 50%. Imagine that in our time, we had an interest rate of 50%, we were done. We were done, and I guess the currency market will explode. Because they said, Great Britain said at that time, the central bank must increase this interest rate to keep strong the currency, in that time, in this case, the British pound. But it wasn't able to keep strong that currency, the British pound, because they had a very weak economy against the German economy. So they pushed a lot of money into the market. They made a lot of interventions to hold this border of the 6% volatility. And at the evening, at the afternoon, at the September the 16th in the year 1992, at the afternoon, the British pound fell down very clearly under this border of 2.73 German mark. And they tried again to make interventions because they had a lot of reserves of currencies, so they can make all that interventions. A lot of billions of British pounds were burned in that time, only to keep that border, but it doesn't work. It was the game of supply and demand. In the evening of the September the 16th, in the year 1992, Mr. Lemon said to the press, "We cannot hold that line," and we made the exit of the EWS. What was the result? The British pound sharps down, has a great loss, and decreases very, very sharply. And Mr. Soros, he knew that. He was a very smart guy. He made with his hedge fund, and that's one day, $1 billion. He speculated against the Bank of England, and he won. Ladies and gentlemen, that's the game of supply and demand. What learned we about that? This event showed us the functionality of the currency market or the Forex market, because the smart money doesn't interested in the politics in the past, in our time, and in the future. The politics cannot say what smart money has to do. It was in the past, it was today, and it will be in the future. There's some opinion in the market that the Brexit, which will come next year, will guide to another Black Wednesday or maybe Black Friday. We will see what will happen. So be patient about the British pound. Let's come to the end. In the year 1992, we have the contract of Maastricht. And in the year 1902, we have the origin of the euro, our great euro. So the euro comes, first the contract of Maastricht, then the euro introduction, and at the end, some numbers, data, and facts for you. Today we have some called fixed exchange ratios and flexible exchange rates, and it's called free floating and a dirty floating. So what is free floating? Free floating, you have no limits in trading between the different currencies. You can trade euro, Swiss franc, euro, British pound, euro, US dollar, whatever you want. It's no limit there. It's not a border. It's not. Yes, a limit of up and down. You can trade whatever you want. But there's dirty floating. Dirty floating means if the central bank intervenes in the currency. Maybe you remember some years ago in the Swiss franc, it was that January 2015, January the 15th. And you know what happened at that time with the Swiss franc. That is called dirty floating, when the central bank intervenes in some of the own currencies. Some data in the currency market, we have a value or an amount of a daily handled amount of $5 trillion, or in German, billion dollars. $5 trillion every damned day. It means $20 trillion every week. I guess it's enough money for you and me to make money in that time. One of the biggest clients or the biggest members or attendees in that market is a fund or a company, maybe you know it, it's called BlackRock. BlackRock was under investigation this week here in Germany, or last week, I guess, but they handled a volume from the own clients in a value or in an amount. Listen to me, it's unbelievable. Only BlackRock traded and handled an amount of $5.70 billion, or in American, trillions dollar. It's the same amount at the daily handled volume of the Forex market. One company, BlackRock. Now you know which is your gamer you play in that market. You know that. So that's the reason why I every day say to my clients, and every week in our English webinar tomorrow at 11 again, I said, follow the smart money. Follow it. It's important because the smart money says which way the money has to go. Don't forget the man who broke the Bank of England. He was involved with more than $1 billion. And he said what had happened because he knew it. And that's the reason why I said, follow the smart money. Look at the daily chart. Look at the weekly chart. If you want to make trades in hourly chart, look first at the daily chart, whereas the smart money is involved, and follow it. Follow the Titanic, and don't cross it with your own small boat. It doesn't work in the long term. Follow it, and don't cross it in front of the Titanic. It's maybe you can make it one time. If you're strong enough, like me, you can make it a second time, maybe a third time, but not for a really long time. It's always better to follow the smart money. How you can use the Forex market. And now it's time, Jens, give me 5 minutes, please, or maybe 7 minutes. Write it down. Currency market is like
5
leverage.
minutes, yes, but 7 o'clock German time, I have the next webinar. So everybody who's like to see a German webinar, today we have a special webinar with Giovanni Ciccivelli, one of the most famous day trader in Germany. So if you want, go to admiralmarkets.de and there you can register for that German webinar too. So it's a couple of minutes more you have, but then Giovanni.
Okay, thanks. Give me 7 minutes, then I'm done. Write it down, please. We decide in the foreign market between the different lots. So you trade lots in the Forex market. First, you have the normal standard lot. 1 pip. Pip is called price interest point, has a value of $10 or 10 euros here, whatever you want. Then the smaller count, the smaller is the mini lot. 1 price, 1 pip is €1 or $1. And you have the micro lot. 1 pip is 10 cent in euro or in dollar. So for every account size, you can trade in the Forex market. How you can make money now in the Forex market? We trade for pips, not for money. We trade for pips. For example, you want to sell the euro against US dollar. You want to sell, you go and you speculate that the euro falls down from 1.0695 and you buy back at the price of 1.0625. You made money, you made pips of 70 pips because you speculated on the falling euro and you win 70 pips. If you bought 1 standard lot, you make money of 700 euros because 1 pip, $10, 10 euros, you made 70 pips, 1 standard lot, 700 euros. It's not so easy. That's the reason you can make money. But please, in God's name, follow the smart money. Hold on your rules, please. It's so much important. I praise you. I beg you. Learn trading. Don't waste your time. Don't waste your lifetime. You have only 1 life and you don't know when it's over. Learn trading like us in Admiral Markets, the best broker here in Europe you can use. You can choose for your trading. I swear to God. Look at the webinars. Come into your education service like this one or call whatever you want and learn it, please. In God's name, learn it. Don't waste your time. And next Wednesday, we talk about futures. Thanks a lot for your attention. I wish you a great evening and I hope you learned a little bit. I know it was a dry topic and I hope we see each other tomorrow, and I wish you all the best and a nice evening, and maybe we will see us in my education service. And with these words, with this in our mind, back to Jens.
Thanks. I guess it was just a couple of minutes, not 5 or 7. But anyway, 7 o'clock in German time, so around about in 11 minutes, we have the next live webinar from Admiral Markets in German language. So if German is okay, just go to our German webpage, admiralmarkets.de, and you can still register for it. If German is not okay, the next English webinar tomorrow, real-time daily trading ideas, 11 o'clock German time, 10 o'clock London time, 12 o'clock Eastern European time, global series. So check out your global or local time zone. Go to admiralmarkets.com or your local webpage and you can register for that. Thanks. And if you'd like to see and watch that again in a couple of hours or maybe tomorrow, we will have it recorded on our YouTube channel. Just go to youtube.com/admiralmarketsfx. Thanks. Have a nice evening. Goodbye. See you soon.